Hi, everyone. My name is Allison DeJager, and I work with List Self Storage. As you may know, List is a platform for buying, selling, and financing self-storage, conversion, and development property listings. We actually recently launched our platform in the UK. So these video chats are a forum in which self-storage professionals can discuss common industry questions and little hiccups they encounter. Each session focuses on different aspects of buying and selling properties, and they'll be yours to view anytime, anywhere. If you have any questions following the video chat, shoot me an email at Allison, A-L-I-S-O-N, @listselfstorage.com. So today we want to discuss the state of the market and the direction in which we're headed. We're joined by Brett Hatcher of the Hatcher Group of Marcus and Millichap and Devin Huber of the BSC Group. Hi, guys.
Hello.
All right. Can you just tell us a little bit about yourselves and your experience in the industry? Devin, why don't you get us started?
Hi, well, thanks for the introduction. I'm Devin Huber. I'm one of the principals and founders of the BSC Group. We started back in 2009, and what we do is place both debt and equity for self-storage owners, investors, developers, operators nationwide. Over the last, I guess it's 12 years now, we've placed about $3.5 billion of debt. So we average about $300 million a year. We're very active in the space, and we pretend to know it pretty well.
Brett, what about you?
Devin, good to see you. I've done a lot of business with Devin through the years, and good to meet via Zoom, see you via Zoom. And this might be the way of the future here now that we're going backwards a little bit, but look forward to catching up in Vegas as well. Brett Hatcher with the Hatcher Group of Marcus and Millichap. I've been with the company about 16 years now. We have 11 brokers spread throughout the United States, 3 in Palo Alto, 1 in Indy, and then the rest here in Columbus, Ohio, which canvass the United States. We are seeing quite a market here, and it's exciting.
So on that note, actually, what trends are you seeing? And we'll just kind of go back and forth. So Brett, will you start us this time?
Well, let's just say the self-storage is no longer the redheaded stepchild or the diamond in the ear that no one knows about. Everybody seems to be, looking to get into this space. I probably get 4 or 5 calls a week from new investors, and it's from the small local regional investors to the larger private equity companies that are looking, and it's really fueling the market. I've never seen values at where they are. I think we're in a perfect storm where we have interest rates at all-time lows. You have the capital that's readily available. I think that's the biggest thing. I mean, the capital and the interest rates propelling this market. I mean, when you're borrowing at 3.5 and, the amount of equity that's out there chasing return, and self-storage has performed very, very well. Even in the last 6 months, we've seen occupancies, increase the way we haven't in many years. So it's definitely an exciting time. It makes me a little bit weary on, where we, at what point do we hit that peak or bubble, so to speak. But right now, I think our runway's got, at least another 12 months on it. If rates creep up, we're going to still be okay. But there's enough capital out there driving values up, and development is starting to spike a little bit. So that's been an interesting, kind of calmed down a little bit at the beginning of COVID. And then when the values, spike back up right after COVID, which I would say probably is the peak of all markets I've seen in self-storage. I thought in 16 we were kind of at the top. We went down a little bit, not much, but it's come back up and been very resilient. The REITs are out in full force. Private equities at an all-time high. Your regional owners are looking to expand because they're doing so well and they're sitting on capital. So, self-storage is as hot as ever.
Thank you. Devin, what did you add?
Well, Brett did a great job covering it all. It's funny, he can use the red-haired stepchild reference because he's a redhead, but a guy like me, I'd have to say a gray-haired stepchild. But anyways, the theme, I guess, that I'm seeing is that self-storage is expensive. It doesn't matter what you're looking at. It's expensive for the tenants because rents are at an all-time high. If you're buying self-storage, it's extremely expensive because cap rates are at an all-time low. If you're building self-storage, it's expensive because all of your inputs are through the roof, whether it's steel, lumber, you name it, land, everything. Labor is, at a relatively an all-time high. So self-storage is extremely expensive, and it's for a lot of the reasons that Brett said. We've got massive amount of equity entering the space at levels that we've never seen before. It currently is easier to get equity for deals than it is to get debt. So, equity is the easy part right now because there's just so much of it trying to get into the space. Lenders are adopting the product type, ones that have never, lent on self-storage before are trying to get into the space, trying to build their portfolios with self-storage because other asset classes, through this pandemic aren't doing nearly as well. And so, as an asset type that they never wanted to enter before, all of a sudden they're very curious about it, interested in it. And, we're seeing lenders from, lenders wanting to do construction debt, lenders being willing to do C of O debt, willing to do bridge financing in the middle of lease up. And then, as always, the permanent debt market has always been very liquid for self-storage. And, right now, as Brett alluded to, it is as competitive as we've ever seen. You're seeing stabilized, self-storage facilities borrowing, 10-year fixed rate money. 3.5% is probably a high rate. We've seen it at 3%, and we're starting to see low leverage stuff break that 3% mold. So, as Brett said, when interest rates are that low, it's really the only thing in the space that isn't expensive is the debt. But when interest rates are that low, it allows people to pay more. And so, I think these low interest rates are helping drive value as well as the amount of equity trying to get into the space. And, I think that trend, continues, continues at the level it is. Whether or not it's going to continue to get more aggressive, I don't know, but I don't see anything changing, where interest rates are or the amount of equity trying to get in.
Hey, Devin, you touched on a good point, and I actually want to know this. When it comes to the amount of equity they're putting down or their loan to value, have you seen that slide from the higher leverage to like the lower, like the mid to lower? Because I feel like the 80% LTV may not be out there anymore on the CMBS side. Bank side, yes, but not on the.
Oh, it isn't available, and we're in a unique time where, for the first time, loan to value doesn't constrain a loan because cap rates have gotten so low. And not to get technical on it, but really what is constraining a CMBS loan is debt yield. And so lenders are currently lending at an 8% debt yield, or CMBS lenders are lending at an 8% debt yield. Some are going slightly below that. But when you're buying a property at a 5 cap, at a 4.5 cap, or even seeing some properties pricing below 4.5 cap, and that's based on in-place income, not pro forma income, you can't borrow 75%. New acquisitions right now, we're not seeing loan to purchase prices above 65% for the most part. And that's not a function of the lenders. That's just a function of the amount of cash flow that asset has and the price people are willing to pay for that cash flow. Back when cap rates were 7-8%, you could borrow 75-80% because there was enough cash flow attributed to that asset to still service that debt. Now, with cap rates as low as they are, it's very difficult to find high leverage. Where we are seeing higher leverage is when, on bridge financing and construction financing, where they're really lending on pro forma income and willing to stretch because they feel that, okay, I can go in today at 80% because I know in 3 years the LTV is going to be, in the 60s or 50s. But permanent financing, you're just absolutely not getting anywhere close to, 70-75% anymore.
That's good info.
You kind of touched on like some of the more aggressive investors entering the space. How have traditional buyers had to adapt?
The hard part, I think, well, one, I think it starts from the top in the REITs. I think you've seen Public Storage be more, you've seen NSA be more aggressive. I mean, you've seen some of these REITs really get out there. I mean, they're putting $1 billion plus in their, in acquisitions a year each. And
Brett,
so,
Brett, just quickly on that note, is it a function at all of the stock prices of the public REITs that they're able to pay so much more?
You know what? That's a great question. I think it's a little bit of just like a confidence level, but I don't think it actually goes down to that. I think when they're sitting on $3 billion line and there's
Right.
opportunity out there, it's more of a strategic plan per the company. I mean, I think if you look at some of the acquisitions Public's done, NSA's done, I think they're just in this growth mode because they've done so well. So, I mean, it definitely goes into that, but I think realistically, I think it's more of their business plan per each one. I mean, not all of them are buying at the same time, at the same level,
Mhm.
but I think it does go into a little bit, but it definitely starts there. And sorry, it definitely starts there with the REITs though, because when they're active and aggressive, it kind of takes some of that inventory off the market. And now the PE companies are stepping up and, they're borrowing, like Sean said, sub 3, around 3. When you look at that, all of a sudden they're gobbling up a big chunk of it. And it leaves that private local regional type buyer who used to really get a decent return that has to be more aggressive. But we're kind of in a weird spot because even the regional and local buyers are getting to the point where they have great relationships with their banks. They're borrowing at great rates, and they're being aggressive. I'm closing a deal next Monday with a local buyer who's buying a $16 million deal, and it's around a 4.8 cap. So when you look at, even they're getting pressure to push it up, but they're all sitting on equity. I think we're kind of in a position too where if capital gains go up in the fall, which we're expecting, from everything, the lobbyists and our council's telling us at Millichap, it's not going to go to 40%, but, you could see it be around, 29-30%, which is more historically normal. And if they do, I think you're going to see some sellers pull off. I mean, right now, the buyer and seller expectation have never been farther because they all hear what's going on in the market. And the seller's expectation keeps going up. The buyers are chasing them and they're stepping up the majority of the time, but there's still that gap. But if we start throwing another 10% and capital gains on there, you may see some sellers say, listen, I'm going to hold the property. I'm preparing for that. Maybe I'm a pessimist because I've been through 7 and 8 and 9 but I've been saying this for years. If rates stay down, I think it'll ease that a little bit. If we would see a little bit of a rate increase and capital gains go up, I think it would slow the acquisition side and make it tougher, especially for the routine or the local or regional type buyers. I think the REITs are still going to be, sitting on, a line of cash that they're going to be able to buy on. The PE companies are still flushed with funds that need to deploy, but, it's still going to be a very competitive market, regardless of whether the transaction volume continues the way it is. I mean, we're up over 100% in the amount of transactions we've had this year. We're probably about 120%. So, given average, where we close 60, 70 deals a year, we're already above that right now, or in July, we're above that. So we're projecting to be, 120, 140 transactions. Volume numbers are double that. It's just wild to see what's going on.
Well, that's great. Our clients, we service a lot of the middle market storage operators out there, and a lot of them are having a tough time finding product because, like you said, Brett, it starts with the REITs, and the REITs have been so aggressive that it's been tough for them to win deals, given the yields that they need and given their cost of equity. So it starts with the cost of your capital. And what we're seeing, we get a tremendous number of calls from, groups saying, hey, can you go find us cheaper equity? We need cheaper equity to compete with, some of these major players out there. And so, that's, a way to pay more for a property is to, have equity that requires a lower return. So we're seeing a surge of demand for that type of equity, and it's out there. And like we talked about previously, there's so much equity trying to get into it. They're willing to take a lower return to get into it. We're also seeing some other creative ways. Groups are acquiring properties. One is a lot of groups are looking at the expense side of things to juice their returns. So we're starting to see a lot more automation out there, where there are these investors who are going to strip a portion of the payroll out. They're going to do some other things to try to increase the yield by reducing the expense side of it. We're seeing a lot more buyers entering secondary and tertiary markets, trying to find return there, and we're quickly seeing cap rates in those markets compress because right now there's equity trying to chase those markets to get a little more yield than they're going to get in say a top 25 MSA. We're seeing a surge in demand for boat and RV storage from the investors because for a while there was yield to be had in boat and RV, but we're again seeing boat and RV cap rates compressing rapidly. One of the interesting things about boat and RV investment is that cap rates are compressing, but it's very difficult to get debt for those type of properties because there aren't a lot of vertical improvements. So if it's just a traditional paved, gated, a few amenities type of boat and RV facility, it's difficult to, even though those may be trading at a 5 cap, it's very difficult to get debt on those. We're seeing a lot of investors who hadn't considered development or C of O investing. We're seeing them trying to enter that space just to get yield. So it's all about trying to think a little differently and try to find yield in places that traditionally you haven't.
Yeah, no, I think you touched on some really good points that I wrote down. I think one of them is you talk about the expenses. On the flip side of that, the biggest head we're getting now too is some of the real estate taxes, and especially I'm sure you have to deal with it. Is if they're paying on $3 million, we sell it for $12 million. They should go up significantly. It's trying to happen. A lot of municipalities, a lot of states have figured out the old LLC transfer drop and swap isn't as foolproof as it used to be. They're starting to look on, especially when you put debt. I mean, I know CoStar and I forget, and I know Fannie and they buy Fannie and Freddie too. They get any deal that CoStar essentially sells this to law firms that see these transfers and the LLCs, and they're triggering them to go at the reassessment. So that's been a tough one on the expense side for us. But I do see you have to be creative on those expenses. And for the boat and RV, I would second that. I mean, it has become more and more popular. I mean, as you see the population become more wealthy, I mean, savings accounts are at an all-time high. I mean, people are spending more, they have that extra money. They're buying the boat, the RV, the extra toys. That's becoming more and more popular from our investment side too. And the other thing I would second is that lease up. There was 3 or 4 core funds that were going after, the lease up market. And we're starting to see more and more buyers go into that market, understanding they're not going to get it on the front end, and they're raising their capital on an IRR basis on an exit side, and to build a portfolio of quality assets, which I can get behind. If you're in the right market and you have a quality asset and you got to pay 20-30% over cost of it, we're seeing cost actually go up anyway. So if you built it 2 years ago, I mean, the spread of that, almost 10% of that, the cost has already gone up that. So you're only paying 10% over market of what you pay right now, but you get it done. You don't have to deal with it. You don't have to deal with zoning, and you may have a little bit of lease up already in place. One thing I will say is if you do have a slower lease up, it can hurt you on the front end if you do try to do that, and I've had a few of those, but to see the lease up game has definitely increased over the last 12 months. It was really since COVID kind of started breaking a little bit of free in July and August of last year.
And you mentioned lease up, and it just made me think, what we're in the last 3 months, we've started to see leasing slow a little bit and rents not rise as quickly as they have previously. And I think it's part of the push into lease up deals is that, you saw the performance of assets over the last 12, 18 months during COVID, just the leasing velocities be so high, rents, start getting so high that, people are, when they're underwriting that, they're looking at it and seeing the time frame to, profitability, the time frame to their exit cap really reduce. And so the risk of those lease up deals, at least in their eyes, was much smaller because, again, rents were much higher and leasing velocities. We've started in our shop to see that slow down to, rents, starting to, come down. We don't have a big sample size, but, we are seeing that slow. So, I wonder if that is going to play an impact on the, demand for lease up deals, going forward, and if that really is a trend. Because that is one of my concerns is how sustainable is the rent environment that we're in right now. And again, I'll repeat it, we're seeing it in our shop that it seems like we have hit a peak, and it's starting to flatten a bit. There might be just an absolute price point where a customer just isn't willing to pay anymore. At some point, you're not going to spend $250 for a 5x5. So we'll see how all of that pays out. But it just, your comment on the popularity of lease up deals, that just sort of spurred my thought there, Brett.
Yeah, no, it's funny too on those lease up deals. The hardest thing for us, and we look at a lot of them right now, is they spec $100 for a 10x10. And right now they're leasing up like crazy, filling the occupancy, but their rates are $65. They're 30% below, 35% market, but they want to sell it as if it's $110 for that 10. They want to throw it on that future value. So the occupancy I've seen has grown and done pretty well over the last 12 months on some of these properties, but the rents are low. So it's a matter of getting the buyers and if you are a buyer to understand, okay, is that rent when I can start maximizing it? Because you're right, at some point. I just had a client near in Ohio, small tertiary market, was getting $65 for a 10x10 gravel, regular drive up, and he's getting like $95. I mean, it's crazy to think that the rent has gotten that much more. At some point, there has to be a breaking point, and it'll be interesting to see, and especially as a construction wave comes again, is hoping that these developers understand that these rents are, they can't spec these super high rents because at the end of the day, it's cost and convenience for self-storage. And sometimes these newer developers or developers in general want to think that they have the best product in the market and they're going to get a premium rent. And that is okay. There are pockets and it really does well. But at the end of the day, I would say to anybody who's listening to this or watching this would be really be conservative on your numbers, that you got to make it work. And I've pushed some developers to not build some stuff and they still push through, and some of them worked out and some of them are a lot slower. So, understanding that gray area in that lease up is very hard to understand. And I'm sure, but that's probably where a lot of the bridge debt comes in to kind of, to get to those points where they will, because a lot of these properties, even if they're slow, they are going to fill up at some point. You don't see many storage facilities at 50% full, they're around for 5-10 years, you're going to see those still stabilized out, so you really got to understand. And I advise everybody who's really getting into it is understand that level of risk, especially on the development side, is it takes you a year to get it planned and half a year to a year to get it built. So it's 2 years in, they say, 18 to 24 months, realistically I say 3 years, unless you're in the right market to get to stabilized rent, stabilized occupancy. But that's a 5-year window where you are susceptible to the markets moving. And so that does concern me if you start seeing rates hike up and all of a sudden you projected out this, 6 cap or 5.5 cap on your pro forma refi, and rates go up to 4.5%. You may see, all of a sudden you may be a 6.5, 6.75 on your refinance. So that, along with taxes, that's some good things to always consider while you're dealing, with the lease up, with the development, stage.
Yeah, and to take that point just a little further, it's interesting. A lot of the product that, or some of the product that came out of the ground in 2017, 18, 19, just prior to the pandemic, we were getting a lot of calls from people who had 50, 60% occupied facilities. They were at the end of their construction loan. It was time to start amortizing, but they were stuck at 60%. Their rents were, 70% of what they projected, or sometimes worse than that. And there was this real need for bridge financing or something to carry them to. So there was, I'm not going to say a lot of pain, but there are some assets that, were stressed while the pandemic hit. And properties that we were not able to get financing for prior to the pandemic, because of the performance of these assets and really the increase in the rental rates that happened kind of during the last 12, 18 months, has taken these assets that were arguably broken assets or would need several more years to truly stabilize to a level that they'd meet their pro forma. That time frame shortened to the 12 months of the pandemic. So it really was a savior for a lot of the stuff that came onto the ground in 17, 18, 19 with all that new supply. And now a lot of those properties have stabilized. The rents are closer to what they pro forma, and they have been able to exit their construction loans without bringing in new equity. I am concerned though about a lot of the new development that we're getting calls on, and people talking to us about financing them, because the rents that they are pro forming are the rents that we're seeing advertised on the internet today, the street rates that are at an all-time high. And they're expecting to not only have that rent but have that rent grow over the next 3 years. And they're looking at very short lease up times. And I just I feel that's one of the big threats to the industry, is because of how high rents are and because of how low cap rates are, that we're going to see this surge of new development again, and it's going to cause an oversupply. And we're going to be back in that same spot we were 18, 24 months ago prior to the pandemic, where the rents were softening in most markets. And there were a lot of deals that, again, I don't want to say are broken deals, just deals that didn't lease up in 3 years. They're going to need 5 years or 6 years, 7 years to get to the projected pro forma. So it's interesting where we're going to go from here.
Yeah, no, I think you made a good point too, and I think it's every buyer asks the first question is like, what's being built in the area? Because when you're competing against other properties in lease up, it is like a race to the bottom until you can fill it, and then you somebody builds next to you, you could put another year or two on to your original projections, and that's the scary part, especially with these developers. And when you're looking at developing a deal, it's easy to put an extra 20,000 square feet. It didn't work at 70,000 square feet. So you put another 20,000 square feet, don't move your expenses much. Oh, the deal makes sense. Well, the market didn't need that extra 20,000 square feet. So now you're oversaturating yourself. And then, if two people happen to enter the market around the same time, downtown Columbus was that way. I mean, it was soft for a while. It's come back and it's got more people more bullish, which will make people want to build again. And the same way with, you saw it in Nashville, you saw it in Raleigh, South Florida, Denver, Dallas. Those markets were hit hard a few years ago with new development, and then it kind of cooled off, but I feel like it's getting ramped back up, because a lot of these developers too have done very, very well. They don't want to retire. It's a pretty fun game to build these things. So I don't see it stopping anytime soon, but it is going to be a little nerve-wracking to see if things do slow down a little bit, because rents don't continue to go up forever. At some point they're going to flatline, even if people, and people are going to continue to put more product on, especially as rents go up, then they're justifying it. Was, a market, you're $12 a square foot, it made sense for development. Now $12, it really doesn't. You got to be at $14 just to put in with steel, subs and everything else, because that's the biggest issue too, and you're going to deliver late. I don't know many construction developers who have delivered on time or early at budget. A lot of these things, we had one listed in Florida. We were listing it in February, supposed to deliver it in June, and it got delivered 12 months after that. It just got open. So you have to be prepared for something like that. And obviously the bridge is a good opportunity. And so you got to plan the worst case scenario, because everything right now is great and everything's doing so well. But you've always got to look at this market is cyclical, and typically 7 to 9 year tranches. We're well past 9 years right now on the bull run we've been having since, I would say, probably 12 or 13. It's been hot.
Yeah. And, I guess on a positive side, Brett, there are some governors in place, for on the development side of things. And, one of those are the lenders. Even though there is ample capital out there for development, the lenders are being they're acutely aware of, the ability for new supply to enter the market. and they're being relatively conservative with the terms that they're putting out. So lenders are acting as a governor, in the development pipeline. And like you pointed out, because costs are where they're at, it's tougher and tougher to get deals to pencil. Now, the flip side of that is rates have shot up. So, in an Excel spreadsheet, all of a sudden these deals are penciling out. 6 months ago when a 10 by 10 was $120 and today it's $200, that makes the pro forma look a lot better. And so, we've actually seen that deals that, people weren't willing to do 6 months ago, they're willing to do now because of where rents are. And again, I don't know which way it's going to go, but I'm curious, if we have this conversation in 12 months, where are rental rates going to be? Are they going to be at the same place, higher or lower? And I think a lot of deals hinge on that because people are looking, people are making deals work at today's rents, which have increased significantly in a very short matter of time.
You're exactly right. I'd say you talk about rates increasing. I mean, I have deals that, we took out to market to where we put them in contract, and by the time they close, they're up 10% in revenue. So it's exciting. It is exciting time to be in the space.
No, absolutely. So
actually was what I wanted to ask you about, just what you predict kind of going forward. I know that's a really tricky question to ask right now, given like the crazy year we've had, but what do you predict?
I would say, I want to be optimistic, but be realistic too. While I say that, I think the rest of the year is going to be great. It's going to be on blue. I think great. It depends on, it hinges on capital gains and interest rates at the end of the day. I don't think capital is going anywhere. I think of the space in, it's interest rates. It's interest rates and capital gains. If we see a tick up in capital gains, I think the velocity that we're seeing on the sales side will go down. I still think as long as it doesn't skyrocket like the early 80s, or something like that, where interest rates, would go up 2 pips, we'll be fine. But if it's a slow creep, I think we're fine. If capital gains don't get hit too hard, we'll be fine. I still think it's going to be, it's a quality asset. And I think more and more investors are looking for the long-term gain. I think that, the amount of capital out there, whether it's patient on the front end on a lease up deal, or if it's, they're willing to take a little bit less return because they'd rather get a 6% preferred return right now, versus putting it out there in the, stock market or some of the other, equities that are out there that might be a little bit more volatile. So I think I'm bullish on the market. I think the operations, if we do see inflation, the only thing good is that rates should go that rental rates should go up with it. Obviously you're seeing, payrolls going up, to get staffing isn't easy. So I truly believe inflation is on the doorstep, or it's on its way. So I think you're going to be paying more, taxes are going up, but with that being said, I still think the fundamentals of self-storage are very strong. The biggest scare for me is for anybody who's out there developing, doesn't understand it, who's going to go build 120,000 square feet and the saturation is 9, and they get in trouble there. And so that's my biggest worry on the ownership side. The stuff we can't control, interest rates and capital gains, I think those will go up and put a little bit of brakes on the market, which it's okay. We can't run this red hot forever.
Yeah, I think it's going to be a lot of the same, at least in the short term. I don't see the acquisition market cooling at all because of the amount of equity that's still trying to get in. And part of that is because there's a lack of alternative investments that, at a risk-adjusted return can, return what self-storage is, even at the prices it is, with that safety net. I don't see interest rates, moving up in a meaningful way in the short term. So you're going to have, capital trying to get into the industry, and you're going to have low interest rates. So I think you're going to continue to have, you're going to continue to have an aggressive acquisition market. I think debt is going to continue to be plentiful because, lenders have strong balance sheets. They have money that they have to get out, and there's no better place to put it than self-storage. I echo Brett's comments that, I am concerned about development and oversupply, just given, given the, where cap rates are and where rents are, that it just is inevitably going to spur a development spike. With that said, because of the cost of inputs, because of the lack of labor, it's getting tougher and tougher to get deals done. And the governors that the lenders are putting on. So it is getting tougher to get developments done, but that doesn't mean people aren't going to try. So, that's my one concern is oversupply and entering into an oversupply market again.
That's great. Do you guys have any final thoughts before we do close out?
I would say, again, to reiterate, the fundamentals of self-storage are very strong. It's a great place to be in, but I think aligning yourself with folks like Devin or myself, when you're new to it, or even when you've been in it for 20 years, but you kind of went your way all the time, and it always was successful. I think and Devin touched on like some of the technologies that are coming in there, that no manager on site. There are multiple companies now that have shown this platform to work. I think, and list. I mean, it's important some of the vendors or a store, SBOA of being really involved, because I don't think the fundamentals change in self-storage. I think at the end of the day, people like to drive up and put their stuff, I don't think you need to reinvent the wheel. People tried the pods and they're successful to some point, but the major fundamentals of self-storage aren't going to change, but the technology is changing. The marketing is changing, being ahead on your rates and being with, guys like Devin and Sean, who, especially when you're looking at a refinance, do you do it now? Do you do it in November? Do you do it early next year? It's really being in tune with those guys, because you may go to your local lender all the time, but exploring other options, or, or if you're owning and you're considering selling in 2 years, maybe we can sell that as if it were, on the pro forma basis. We are still selling a lot of pro forma, even if it's an established product, because there is opportunity. So I think staying in touch with, people within the industry, we were just talking about going to the show in Las Vegas. Nashville was one of the largest when they did the SSA show earlier this year. It was the most attended SSA spring show, or, that they've had in history. It's important to stay, involved and keep your ear to the ground, because it's easy for a lot of people who have been in the industry for a long time to kind of stay within their four walls in their office because they're successful and they can replicate it. But, it's always important to kind of think ahead and make sure you're covering every angle and that you don't get in trouble down the road, whether it be you hold on to it and you were planning on refining farther out, or you were going to sell in 2 years and you could have got more money now. I mean, I definitely think the peak of the market is now. And how long that lasts, I think there's still a little bit of runway, but I don't think overall things do have to, everything's cyclical and will, change at some point.
Yeah, well, I think we've covered most of it already. I consider myself extremely fortunate to be in this industry, because it has just, I've been doing this since 2005. We started the BSC group in 2009, but storage has just weathered the storm, in and out, no matter really what happens. Self-storage seems to come out looking pretty good, and just seeing a lot of other asset classes struggle, and self-storage, not struggle but actually accelerate. I count my blessings to somehow I stumbled upon this self-storage niche. So very excited about that, and excited about seeing everyone in Vegas in September. And I'll leave it there. Allison, thanks a lot for having us. This has been a pleasure. So thank you.
Thank you, guys.
Allison and List Self Storage.
Thanks so much. I appreciate it, guys. This is, I do think, one of the best parts of the industry is that people with your expertise are willing to share, their successes and their stories. So thank you. And thank you everyone for attending this installment of Coffee and Conversation. If you have any questions or comments, send me an email, Allison, ALISON @listselfstorage.com, or give me a call at 248-795-8126. Thanks.